What kind of protection do you have for your portfolio? Today's short video will look at some strategies for portfolio protection. I'll start with some basics and then I'll get into some more complex strategies, including inverse ETFs and options. If you're new here, welcome. If you've been here a while now, thank you for your continued support and watching. The volatility in today's financial markets makes it feel as if there's uncertainty waiting around every corner, much like it can feel walking through a hedge maze. But you can use hedging to your advantage in the form of portfolio protection. The protection strategies I am going to mention go in order of least risky to most risky. I am not recommending you specifically go out and do any of these right away, just informing you that there are strategies that exist if it interests you and warning of potential risks with each one. The first portfolio protection strategy is good budgeting, cash flow management, and a dedicated emergency fund. I won't dwell too long on these, just know it starts here. I recommend following the Money Guy Show financial order of operations pictured here. The second portfolio protection strategy is adequate and appropriate insurance. And why is that? Well, a liability or insurance claim or a lawsuit could easily wipe out your portfolio. The important insurance that come to mind are definitely health, life, long-term disability, auto, homeowners and renters, and umbrella. Why protect? You purchase life insurance to protect your loved ones for your income replacement if you were to pass away. You carry health insurance to protect against catastrophic financial devastation due to bills incurred from healthcare. You purchase long-term disability insurance to protect your future earnings in case you lose the ability to earn income in the future. You carry auto insurance for the perils of driving, and renters or homeowners insurance for your property and liability protection. The third portfolio protection strategy is a solid asset allocation strategy with a rebalancing component. I just watched a snippet from the Money Guy show this morning where there were two people with a 60-40 stock bond allocation in retirement. One of them rebalanced annually, the other did not. That simple decision equated to over $300,000 more between the year 2000 and now. So a solid asset allocation strategy that you adhere to and then rebalancing annually could be your first line of defense. The risk of asset allocation is that everything goes down in value anyway. You can diversify away to an extent, but the entire financial system is interconnected, and it also heavily relies on the US dollar as the reserve currency. If for some reason this were to change in the future, that could be another risk. The next way to hedge your portfolio would be buying inverse ETFs of the indexes. You would need a brokerage account to be able to do this. You wouldn't be able to do this inside of your employer retirement plan. Brokerage accounts can be taxable or tax advantaged, so make sure to use all your tax advantage space when you can. As far as timing when to buy inverse ETFs, that would be when you think the particular index has hit a short-term or long-term peak. I usually base this on short-term oversold or overbought signals on the channel commodity index or the relative strength index, but you can do it on weekly or monthly timeframes as well with the indicators of your choice. As an example, the ticker symbol SH is the inverse of the S&P 500. You could purchase shares of SH in a brokerage account and SH would go up in value if the S&P 500 went down. Today, the S&P 500 is having a down day, so you can see that over here the price action of SH is up. If you want to take that a step further, you can tread cautiously in doing so. There are also leveraged inverse ETFs that return 2 times or 3 times the opposite of the S&P 500. To find inverse ETFs on any of these, I usually just enter it into a search bar such as Google, so it's really not that difficult to find them for this strategy. If you're enjoying the video, please send some YouTube currency and smash that like button to help me out. The next strategy is a bit more involved and slightly more leveraged. That is buying options, specifically puts. You would need a brokerage account, and again, you can do this in a taxable or tax advantage brokerage account. To trade options, you need to apply for options privileges. That involves a questionnaire regarding your investment knowledge and experience. There are different levels of options approval, but buying puts is usually the most basic level. Here are some examples of some recent puts that I purchased and then sold. An options contract controls 100 shares of the underlying security. This is why it's highly leveraged. It's using a little bit of money to control a lot of money. It's similar to when you put down a small down payment on an expensive home, you're using leverage. As the buyer of an option, you have the right but not the obligation to do anything. The money you are risking that you pay for the option contract is called the premium, like paying an insurance premium. That's why you're buying puts, insurance on your portfolio. When you buy a contract, you are never risking more than your premium paid, because as the buyer, again, you have rights, not obligations. The goal is not necessarily to make money on the put, but that would protect your portfolio if the downturn that you fear were to come to fruition.
Here is a real-time example using the Qs and looking at if I thought that the Qs were going to go down in the future, how I would probably play it. And I'm not saying this is what you should do right now, just giving you how it actually works. So options chains have different expiration dates when the contract's going to expire. Typically, I'd look at least 6 months out because there's a lot of liquidity in these and there's people on both sides of the trade. So you could easily get in and out of this. Looking at August 18th, let's just keep the math easy. If you had $30,000 worth of the Qs, that would be about 100 shares. You could offset that risk by buying one contract, because remember, one contract controls 100 shares, and you would have to pay somewhere between the bid and the ask price here. That's how much somebody's asking. Just like when you're selling a house, this is the asking price, and this is how much somebody's willing to pay for it. Somewhere in the middle there is where you can get your order filled. If the Qs were to go down in value, the premium would increase, and then you could potentially sell it. All you have to do is look a little higher to see how much it could move up. So if it were to go down $8, you would be further in the money. You'd probably go up about $300 or so. Remember, highly leveraged, controlling 100 shares. So these premiums will increase and you can trade out of them. You don't have to wait until they expire. You can trade it before it expires. And that's what I did on those that I gave the example of before. For however many dollars worth of the Qs you owned, you could choose to hedge a portion of it. You could choose to hedge all of it. And so this is a downside protection strategy, buying puts.
An even slightly more complex strategy than options is using futures contracts. Futures are even more leveraged than options. Typically, one contract will multiply your risk by 1,000 instead of options, which is by 100. Not all brokerage platforms allow futures trading. You need to do them on a platform that allows it. Here are some examples of the best online brokers according to NerdWallet for trading futures. If you want to play around with futures contracts for free, Trade8 offers paper trading. You could try it out. I did. It was pretty fun. I hope this high-level overview provided some choices for you if you're concerned about downside risks. If you have any questions, please leave them in the comments below. I talk about many things finance here, so if you have a video request or idea, please leave suggestions as well. Till next time.